Are you curious about what's going on with mortgage rates, or just want to find ways to keep your mortgage payment low at a time when rates are rising like now? Well, then you got to check out this episode of the Engel and Volker South Bay podcast. My name is Ben Larson. I'm CEO here at Engel and Volker South Bay, and that's exactly what we're going to talk about on today's episode. So if you like this information, then definitely connect with us, whether it's a like, a follow, subscribe to our channel, or turn on notifications, whatever it may be, definitely connect with us so you can get some more of this great information. And if it was one of our South Bay advisors that sent this information to you, then definitely reach back out, say thanks, ask some questions, or just make sure that you continue to get this information. That's what it's here for. So hope you enjoy, and keep in mind what we're going to talk about today. Some of it is pretty time sensitive. So we're recording this the middle of July 2022. So some things may change here in the near future, but the strategies we're going to talk about on how to keep your payment low, those are going to be pretty applicable for the foreseeable future. So definitely save this, keep it around, refer back to it if you want to, or you can just reach out to whoever sent it to you and ask them some questions. But now let's go ahead and get started with this episode. Today, I am here with Michelle Malura from Cross Country Mortgage, and I've worked with Michelle for almost 15 years. She's been in the business for over 20 years. Very knowledgeable, very helpful, gives incredible service, all around great lender. So welcome, Michelle.
Thank you, Ben. Thanks for having me. I love that you guys are putting out these webinars. I think information is so important. Mortgage financing as well as real estate decisions are some of the biggest decisions we make financially in our lives, and they can be a bit emotional as well. So I think it's so important for clients to work with trusted advisors that are actually giving them real data, facts that they can use to make these really important life decisions, these big milestone decisions. So thanks for letting me be a part of this.
Of course, yes. We only bring on the best. So here she is. All right, so I made some notes, had some things prepared for this. There's a lot going on. So regarding rates, I mentioned that earlier. What's happened? We hear about rates going up, but what exactly has been going on these last few weeks or months?
Yeah, so since basically the end of last year, the Federal Reserve Bank has been increasing mortgage rates in general, to try to get inflation under control. Inflation is at a 40-year high. So one of the economic tools that the Federal Reserve Bank has to control inflation is to raise interest rates. So that's what we've been seeing happen since end of last year, and they have consistently raised interest rates at every meeting this year. The biggest interest rate hike that we've seen since in 28 years, I believe since 1994, happened earlier this month in July, where they increased rates by 0.75%. And actually they're meeting again later this month. And there are a lot of people that think we might see a full percentage interest rate hike, even more than last one.
Wow.
So we're not sure if that'll happen. Maybe they'll do 0.75% again, but some people are speculating they may do a full percent. So they're trying really hard to get inflation under control as quickly as possible. Now that being said, that's kind of what's on the horizon in the short term, right. And they'll probably continue to increase interest rates until there's confidence that inflation is under control. But what will likely happen, and what a lot of economists are projecting, is we are going to enter into a recession. Yep. And then what will happen is, in order to help pull us out of the recession, we will see mortgage rates and interest rates go down. So the million-dollar question is when. Right, and we all wish we had a crystal ball to know exactly when all of that will happen, but a lot of people think that within 12 to 18 months we may see a correction where rates come back down again.
That's interesting. I had some questions prepared, but another thing comes to mind as you're talking about that, and what I don't think a lot of people know, and it's confusing, I think, when you say the Fed's raising the rate, what is that directly related to mortgage rates? Does that mean the interest rate on a home is going to go up?
It does trickle down to pretty much everything. It affects all interest rates in general. So what they're trying to do is they're trying to control consumer spending. And so you could say we're going to see rates for car loans go up, credit cards, any kind of consumer financing, it will eventually affect. So yes, the Federal Reserve Bank increasing the overnight lending rate, which is what they call it, does directly impact mortgage rates, as well as other financing rates.
Right, okay. So with the Fed raising rates like that, what does that mean for us, for the buyers that are out there thinking of buying or have been in the market?
Yeah, so it's a big deal because interest rates impact affordability, right?
Of course, yeah.
So a lot of people that started shopping in this market 6 months ago, they might have been looking at mortgage payments that had a 4% interest rate associated to them, and they were comfortable with that payment. Well, now they might have to be looking at a 5.5% rate or higher. And so now their monthly mortgage payment went up significantly. So it impacts affordability. So what that means is for some buyers, it will directly impact their purchase power, which means they can no longer potentially be looking at the same priced home they were looking at in January, because now they can't afford that home anymore.
Yeah.
And for some buyers, it actually won't affect what they're qualified to buy. Some can still qualify for the same purchase price they were looking at before, but that doesn't mean that they're going to feel comfortable with that higher
level, right?
Exactly. So I always say to clients, what's more important than what you qualify for is what you're comfortable with.
Yeah, I've seen a number of times where clients will qualify for a pretty big number, but they look at the payment on that and that's just not in their comfort level.
Exactly.
But it's smart for them to do that.
Exactly.
Good. All right. So obviously I've seen examples of that. Our advisors here at the company, we've seen that. For those buyers that they think rates have gone up and now they're just out of the market, right? That's what they're assuming. Are there ways that they can do something about that to help out the rate situation, to maybe bring that comfort level back to where it's something they can afford and want to purchase?
Yeah, that's a great question. So we do have some specific loan programs that help improve affordability for clients.
Okay.
So we have about 4 main loan programs that I've been sharing with a lot of buyers right now to see if we can't get them back to a monthly payment amount that they're still comfortable with, so they can still be engaged in the market.
Right.
One of the things I'm trying to share with buyers is this is a great time to re-engage because the level of competition has calmed down a bit. And so how can we find a mortgage that still meets your comfort zone for monthly payment so you can stay engaged?
Right.
So we have 4 main loan programs that we are looking at for each buyer right now to see what might be a good fit.
Okay. Can you give us a quick rundown what those are?
Yeah, absolutely. So one of the loan programs we have is called a 2-1 buy down. And what that is a buyer can get the seller to give them a closing cost credit, which can be applied to buying down their interest rate by 2% for the first year of the loan and by 1% for the second year of the loan. So in essence, you're being able to go back in time for the first year and for the second year and make payments on an interest rate that you might have been more comfortable with. And it's a temporary solution to get used to these payments and kind of get back to a payment you were comfortable with.
Yeah, 2% is a big drop. And you say it's a temporary solution. So what problem does this solve for the client? When is that the right fit for someone?
So one client that might be ideal for this program is somebody who is on an upward trajectory for their income. So somebody that knows that they're going to get a raise and then in a year or two they would be more comfortable with a higher payment, but just not today. So there's a lot of young first-time home buyers that they know their income is increasing year over year, whether it's because they're on a set predetermined raise schedule, or they've started their own business and they can just see that their business is growing and their numbers year over year are trending upward. So this could be a great fit for somebody who knows that right now, today, I want my payment lower, but in 2 years, I would be okay with a slightly higher payment. Same would be said for somebody that knows their expenses are going to be coming down in a couple years. I have a lot of clients who will say to me, you know what, Michelle, in 2 more years, I don't have to pay for preschool anymore for my kids. And believe it or not, in LA County particularly, that can be a big number.
Yeah, I just finished my 3rd kid this year, so.
Well, there you go.
Yeah, that expense is gone, finally.
Yeah, or they know they're paying off a car in the next year, or college tuition for a child, whatever the case may be, whatever relates to you. But if you know that in a couple years your monthly expenses are going down and then you would be more comfortable with a slightly higher mortgage, that is kind of the flip side of someone that could benefit from this.
Right, okay. Great. So you had 4 strategies. That was number 1. What else you got for us?
Another one is you can do a straight discount point rate buy down. So this one doesn't get you a full 2% drop necessarily for the first year, and maybe doesn't even get you a full 1% drop like you would get for the second year, but it gets you a more permanent monthly payment rate drop. So again, you can ask for the seller to credit you towards your closing costs and then apply that money towards buying your interest rate down. So, you know, maybe you can get your interest rate bought down to a rate that you were comfortable with from 4 months ago through a straight rate buy down.
So now, how is that, or what situations would that be better than the 2-1 you just talked about?
So that situation would be good for a client that knows they're going to be in the home for a long time, intends to stay in the loan for not just the home, but the loan for a long time, meaning maybe they know they're retiring in a year and being able to refinance in 2 years is not going to be easy for them because they won't have their income anymore. So not only are they going to stay in the home, but they see themselves staying in the loan long term. I've found that typically between the 2-1 buy down strategy and the direct straight buy down strategy, it's usually about a 3-year break-even point. So if you're going to be in the loan 3 or more years, you're generally better off with a straight buy down. If you're going to be in the loan 3 years or less, you get a little more bang for your buck with the 2-1 buy down strategy.
Okay. So that's a good way to think about the two as the options. And, you know, if people do think what you were talking about, possibly rates dropping in the future, year or two, then maybe that 2-1 would make sense.
Yep.
Okay. What else you got? A
couple others. So another strategy, we didn't look at this for a long time, but this was actually a pretty common loan program, you know, back 10, 12 years ago when rates were high again, or closer to where they are now, is looking at adjustable rate mortgages. So adjustable rate mortgages are loans where the loan is still amortized over a 30-year period, similar to a 30-year fixed rate mortgage. However, the interest rate is only fixed for a period of time. And they come in a variety of increments, 5, 7, 10, even 3. And so these rates typically have these loan programs typically have lower rates associated with them than a 30-year fixed. So if you are somebody that feels confident that you're going to likely refinance in the next few years, if rates do in fact come down like people are projecting, or if you know you're going to be moving in a certain amount of time, relocation, downsizing, whatever the case may be, upsizing, then getting into a 7-year adjustable rate mortgage that gives you a fixed payment for 7 years is not very risky, right? So a lot of people tend to gravitate towards the 30-year fix because there's no risk whatsoever with that loan.
Yep.
But when rates start going up and you have to consider affordability, you then have to start asking yourself, well, do I have the risk tolerance for an adjustable rate mortgage, because it's going to save us a lot of money.
Right.
And then lastly is the interest only program.
Okay.
That would be the fourth strategy that we have been, again, using more lately, once again, just with the rates climbing. And those are loan programs that do not preclude you from making fully amortized payments of principal and interest, but you have the option for a period of time, depending on the program you pick, to make interest only payments. So that can be really helpful to keep your cash flow in a better place when you first buy a home. If you only have to make your interest payments versus interest and principal, it may make that home more affordable.
Okay. So now we're talking ARMs, adjustables, interest only. We've heard horror stories of those in the past. So you mentioned risk, obviously. Those are riskier situations, right?
Yeah, they are riskier. So of course, a 30-year fixed rate mortgage has no risk. The rate's fixed for the entire life of the loan. The payment will never change the entire life of the loan for the mortgage. Of course, property taxes can always go up. So,
right.
But I'm talking about the mortgage. So there's zero risk there, right? And for so many years, the 30-year fixed mortgage rates have been so low that it was just the obvious choice for so many people. But now we're at a place where the 30-year fixed mortgage is coming at a significantly higher cost. So it does make sense to consider these other loan programs. They are more risky than the 30-year fixed rate mortgage, but it doesn't necessarily mean they're too risky for you. One could be an absolute perfect fit that gives you almost no risk.
Right. Yeah, it depends on the situation. I'm sure there's times where it makes sense.
Yeah, and I'll give you a perfect example just this week.
Okay.
Perfect example. I have a client who right now, they own 3 homes, second homes and their primary home. And they're a little concerned about getting into too big of a mortgage right now. They're buying their dream home and they're a little nervous about their cash flow.
Right.
But they have a plan. In 2 years, they're going to retire. They're going to sell their 2 other properties and pay off the mortgage of this new home.
Oh.
So they are people that know that in 2 years they will be mortgage free. So for them, it makes perfect sense to address their short-term cash flow concerns with getting into an interest-only loan that makes them feel comfortable for the next 2 years until they retire. And then once they retire, they know what they're going to do. They've worked through it with their financial advisor. And so to that client, as an example, there is no risk for them to go with an interest-only program.
Right.
For them, there's no perceived risk.
Them. So then that's a great example, and it's also an example of why you and your team are so great with the clients is you don't just go off base what they are. You take their situation and you advise them on. They may not know there was an interest-only option, and they're just thinking, well, we're just going to have to pay a little bit more than we're comfortable with. But you can say, what's your situation? Oh, 2 years from now, you're going to pay everything off? You should do this. And you just save them some comfort level there. So that's great.
Yeah, it's really important, Ben, to work with a trusted advisor because every client is so unique. There isn't a cookie cutter, one size fits all loan program. You really need to understand your client's goals, their risk tolerance, their short-term goals, their long-term goals, so that you can advise them properly. So, again, it's just, you don't know what you don't know. And I can tell you there's so much information out in the internet that it's really, it's critical to have a team you trust.
So much misinformation.
Yeah.
The other day you'd mentioned something that I think would be interesting for people as well. It's called the Lock and Shop program.
Yeah, the Lock and Shop is really cool. So I'm excited about this program, and it is a way to address the concern over rising interest rates. So it's a program where up to a conforming loan limit, which in LA, Orange County is just under $1 million, 970. You can actually get advanced approved while you're shopping, and we can lock in a rate for 90 days while you're shopping.
Oh, that's great.
And so as long as you get into contract by day 90 of your lock,
Right.
your rate lock automatically extends for free for another 30 days to close your transaction. So it's a great way for buyers that are a little concerned about where rates are going, and they
Yeah.
want to kind of have peace of mind while they're shopping, knowing my rate is secured.
Right, and like you mentioned earlier, the Fed's raising rates, so if someone knows they can have some security and they think they're going to find something, which is easier to do these days than it was 6 months ago or a year
Yeah.
ago, they can be a little more optimistic about finding something during that time period.
Yep.
That's great. Another little thing I see, out there, you may all have seen this as well. There's a meme going around that says, "Marry the house and date the rate." What does that mean?
I love that meme.
Yeah.
So I think that meme is so brilliant, because what it means to me and what I say to clients when I talk to them about it is, you have to fall in love with the house, right? You want to marry the house. The house is what's the keeper.
Sure.
Your mortgage, you can refinance an indefinite number of times. There's no prepayment penalties on most home mortgages. It's something you want to be sure of and check when you get one, but they're very uncommon. So the typical mortgage has no prepayment penalty on it, which means you can refinance out of it, pay it off, and get into a new loan at any time you want. So the message behind that meme is, what is unique is to find a house you love, especially in California, where the homes are, each one is so unique. You sometimes you never see the same home twice. So if you find a house you love, get the house, and know that if rates do come down in 12 months, 18 months, you can refinance into a lower interest rate at that time, or into a different loan program. So, marry the house, date the rate.
Yeah. All right, now I get it. That's interesting. I see that going around a lot these days.
Yeah.
So, good. All right.
So, okay, Ben, you've gotten asked me a lot of great questions about how to manage rising interest rates for buyers. But, I get calls from buyers every day, and they don't know what to believe. The media is terrifying them. The media is telling people that the market's crashing, it's slowing down, it's going to be a repeat of the Great Recession in the real estate world. And a lot of my buyers are coming to me saying, "Michelle, what do we do? Should we disengage right now? Should we hit the pause button on our home shopping?" How do you answer this question for your clients, or just in general?
Great topic. Our advisors here at the office get that brought to them all the time now. Buyers are hearing all the headlines, and they think things are tanking and they're going to hold off. And there's a saying that I like that says, headlines do more to terrify than clarify. And
Totally.
it's exactly what it is. We all know that. They want you to click on their articles. They want you to buy the magazines. There's always the headlines. And there's no doubt the market is shifting. It definitely is. But you have to keep it in mind in perspective. I relate it when I talk to people. If you're in a car going 120 miles an hour down the freeway, you slow down to 80, it feels like you're going really slow, right? So it's a slowdown for sure, but it doesn't mean things are going down. It doesn't mean the market is tanking, at least from what we're seeing right now. And like you mentioned, there's more rate increases coming. The rates are going to go up. We don't know how that's going to affect everything, but we can talk about what's going on right now. And as you talked about earlier, here at our company, we follow the data. We don't just get caught up in the hype of what it is. And so I pulled some information, and I knew you were going to flip it around on me here a little bit, so I wanted to be somewhat prepared.
So what I'm hearing, just to make sure I'm following you, is what you're saying is there's a deceleration of appreciation but that is not the same as depreciation of values.
Yeah,
Is that kind of what you're getting at?
Yeah, I'm big on phrases and quotes. So that's another one.
Okay.
Another one is deceleration is not the same as depreciation.
Right. Okay.
So, and that is, for the time being, what we're seeing is deceleration.
So what data do you follow as a real estate advisor to understand what's happening in the market and to educate and guide your clients? What statistics are you looking at?
Well, what we follow, and we go over this in our meetings, there's local information you can pull. We have programs that we can use really through the MLS. And we can search different areas. We can go MLS wide, which our MLS is a regional one through a lot of California. So what we're worried about in data and stats is sample size. You know, if there's 3 sales and one's a huge sale, it's going to look like prices shot through the roof.
Right.
But if you have thousands of sales that you're pulling this from, you know, it's a little more accurate because it can't be skewed quite as much.
Okay.
So what we'll pull is in the MLS, we'll pull the data, and I'll look at the MLS, which is called CRMLS, wide, but then we'll really focus on the South Bay as a whole.
Can you define what the South Bay is? Like what cities?
Yeah, there's a lot of ways of defining it. And what we do just to try to get a broad perspective is really anything south of the 105 and west of the 110.
Okay.
And so it's in that area. It's a big sample size, and we'll look at condos, townhomes, and single families too.
Okay.
Because there's other things that could be in there, but we want to look at that. The residential side is where most of our clients are. So we'll look at that. So a couple things I pulled that I thought people might find interesting is, so we're hearing a lot about, like you said, prices are crashing, market's crashing. So what's going on with prices?
Yeah.
This slowdown we felt started happening really right around Easter. Late April, or track it by holidays, I guess, but by Mother's Day we were really feeling it, early May, and so by June we should be seeing some of the effects.
Okay.
You know, because in May you've still got things, the craziness of early April that's still playing in, some of June, but by June, and we now have the June stats.
Great.
So being able to look at that, just to give you a sense, so prices this June over last June. So for MLS wide through a lot of California, prices on average have still gone up 7.5%.
Wow.
So that's what I'm talking about, 180 miles an hour when we've been going, or 120 miles an hour when we've been going up 12, 15, 20% maybe in some areas. You slow down to 7 or 8, and now some areas are going to be a little bit higher than that, some are going to be a little bit lower, but that's the average.
So people perceive it like, oh, the market's crashing, but really there's still a significant, what'd you say,
7.5%.
Isn't that higher than normal, even at that rate?
So it's still good, but like I said, it feels slow when you go from where you were. And then the South Bay itself, we're seeing 5.5. So a little bit below MLS-wide, but still 5.5. It's still appreciation where people are thinking everything's going down. We're seeing all these price reductions, things coming back on the market. The reason we're seeing a lot of price reductions is because people still thought the values were going up 15 or 20%. And so that's where they priced it.
Yeah.
You know?
So they were pricing stuff, building in that appreciation, and then realizing the appreciation has come down.
Right.
We overpriced.
So it's overpriced. It's still selling for more than what it would have a year ago, but they started out pricing it too high. And 10% too high on $1 million or $2 million home is a big difference. If you're $100,000, $200,000 too high.
That's huge. And that is a huge emotional impact as a buyer. If I see a house drop $100,000 in price, I'm thinking like, whoa,
right,
something bad is happening, when in reality it's just a correction to an overprice.
Yeah, exactly. And let me give you another perspective on it. So 3 to 4 months ago, everything was selling. Didn't matter if it was a busy street, it only had 3 walls, whatever the house was. It was selling with multiple offers, and it was going 10 or 15% over list price. That's what's changed a lot. A new home, or not a new home, but a nice home in a desirable area is going to still get multiple offers probably. And a lot of people don't realize that. You're probably still going to get, as long as it's priced well. It's not priced like, values are still going up.
I just had this happen to a buyer yesterday.
Yeah? Yeah,
They went in over list because it's a great house, great area,
exactly.
and they still got outbid by 50,000.
Wow. Yeah.
So this was just
example.
yesterday. Yeah.
Yeah. So it's definitely still happening, and what's not going through the roof, or what are a lot of the places that are sitting. And again, let's remember, if something sits for 30 days, usually that's not a big deal. But when you used to have 10 offers in 3 days, it seems like a big deal.
Right.
But something that may not be a great floor plan, or there might be something wrong with it, those are the ones that may not sell right away. But others, are still selling pretty quickly. And that actually takes me to my next stat, which I thought was even more surprising. Days on market.
What is that? Can you define what does days on market mean?
Yeah, so days on market is just how long has the home been on the market before it went into escrow.
Okay, so before escrow open, not necessarily closed.
Exactly. Yeah.
Okay.
Before there was acceptance, and we moved it into one of the MLS status for being in escrow, basically.
Okay, gotcha.
So number was skewed in the past when things were selling so quickly, because really the days on market were probably 1 day. It would have been if we let it, but you have a few days if you're open houses over the weekend, you're getting offers by the time you counter everybody, and then they respond, you're 5 to 7 days in, and that's what we were thinking days on market were.
Right.
So that was actually skewed at that time. Now I figured, there are more homes selling. It has taken a little longer. So I thought for sure it went up. MLS wide, it's flat.
Wow.
So it had no change year over year.
I'm shocked to hear that.
Yeah, last June was crazy. I mean,
know.
things were moving really fast.
I'm really shocked to hear that it's flat.
It's flat. And in the South Bay, it's actually down over 25%. So days on market going down means there's fewer days on market, which means they're actually selling faster.
Oh, wow. Okay.
So it's surprising. But again, like we always say, it depends on the home. And you have to make sure you price the home correctly, given the situation. And we can't just name a price, basically, like we've done for the last couple of years.
Right.
And you name it, basing it on whatever you wanted to base it on, and you probably even got more.
Right.
So we're not in
What
that space.
about being in the finance world, I always think of like supply and demand and how that affects prices of things and inflation.
Right.
So what about inventory? Is that a data point you look at in analyzing how the market's doing?
It is a data point we look at. It is something that is increasing slightly. But it's still nowhere where it needs to be. I don't have the exact numbers, but it's something we track. And in our meetings, a lot of our advisors will have specific areas that they follow, and they'll come in and report in and say, hey, this area, there are a lot more listings than there were last month or last year. But we're going to be short on inventory from what everybody's predicting for a long time.
That's what I've heard even from the people I follow. On the finance side, economists, people projecting, they say we have a tremendous housing shortage in California that is not going, no one can bridge the gap. New construction can't do it. We just have a huge shortage.
There is a shortage, and we had a ton of demand. We've lost a good portion of it, really, but it's still, we didn't lose enough to make up for the lack of inventory. And at the same time, the millennial generation is bigger than baby boomers.
Wow.
So and a lot of them are getting to the point.
That's exciting.
And a lot of them are getting to the point where they want to buy, and they haven't over the last few years. And so that is going to keep driving an inventory problem. That's part of what's going to keep doing it.
How do you see us as a region, just the South Bay or LA, California in general? What do you see for our outlook? Like, how are we going to address that housing shortage, do you think? Are you hearing anything about ideas that are being thrown out there? Yeah,
and it's probably something we'll do another video or webinar or podcast about, is different ways that the state and the governments are trying to help that. For one, everybody's heard about ADUs, accessory dwelling units.
I hear a lot about those.
There are other bills that are in place. The number of things they're trying to do. I know cities are being more open to housing.
Higher density housing?
Higher density areas where they wouldn't have allowed it before, that now they are. I sold a property where we were told for the longest time it could not be developed for residential. And looks like they're having a change of heart and they need more housing. and they may allow it.
So what I'm hearing, Ben, even though the media is kind of putting doom and gloom out there and terrifying people, when I listen to you give me the actual data of what's really happening, I walk away with a much different feeling. So what I'm perceiving from this conversation is that our market is relatively healthy still. Would you agree with that? What do you think?
I would agree. Yeah, and I think just like all the stuff you talked about on the loan side, people just don't know what's really happening, and so they need to reach out to one of the EV advisors, just like your team on the mortgage side, to really find out what's happening in their area, because they're micro markets and it varies. You really need to know it.
Yeah, I mean, if there's one piece of advice I would give, and I think you would agree to whoever's watching this, is don't go off of the media or your gut or what your friends and family are saying. You really want to talk to an expert, whether it's talking about the financing component or the real estate market and whether or not it's a good time to buy. I just think that, number one, our industry is very opaque and it's extremely complex, and it's one of people's most important, biggest financial investments, as well as one of their family's biggest milestones to buy a home. So it's a big deal, right? It's a big deal on so many levels, and I just think you need to talk to professionals that really can give you sound advice based on facts, not emotions, not on what sells in the media.
Right.
So you can make wise decisions for your family, because we all want to do right by our family, right?
Of course.
Like, we all want to make good decisions for ourselves and our family. So I would say that's my number one piece of advice I could give people.
Well, it's great advice.
Well, thank you so much, Ben, for sharing that information with me. And I think for anybody that's really curious about what's happening in real estate, you should reach out to your trusted real estate advisor, whether you're working somebody here at EV. They do an amazing job of really tracking the data and can help you make informed decisions. So thanks so much.
All right. Yeah. All right. Well, thanks, Michelle. That was a lot of great information. Thanks for asking me some questions as well. Hopefully all of you found that helpful. Like I said earlier, we're very big on making sure the consumers are educated, informed, aware of what's going on. There's a lot of changes in the market these days, as there typically always is. So it's always good to stay up on that. Like I mentioned, headlines do more to terrify than clarify. So we want to give you some information really backing up what's going on. So however you found this, if it was sent to you from one of our EV advisors, definitely thank them. If you found some information, we're going to continue doing these. So be on the lookout for some more. Be sure to go like our social media, find Michelle, follow her as well. We appreciate your time. Michelle, any final thoughts for everybody?
Yeah, just thank you for having me, Ben. And if anyone has any questions for me, I'm happy to answer them.
All right, sounds great. So remember, everybody's unique situation is unique. So if you want to find out how any of this applies to you specifically, reach out to hopefully an EV advisor as a realtor, or Michelle and her team on the mortgage side. Thanks, everybody.
Hi.